Assured Guaranty, ticker AGO, uh, completely missed Q2 2026 consensus across the board today.
Yeah, not a pretty headline.
No, not at all. Total revenue came in at $195 million. That is down 30.6% year over year, and it missed Wall Street estimates of $201.13 million.
Right.
Adjusted operating earnings per share was $1.23, which missed the $1.53 consensus, and GAAP EPS came in even lower at 88 cents.
Ouch.
Yeah. And management, well, they didn't provide explicit short-term quantitative guidance, but they did point to strong first-half production and a robust pipeline for the rest of the year.
Which the market basically entirely ignored.
Exactly. The stock took a massive hit. It dropped heavily in after-hours trading and eventually closed down 8.65% at $75.43 during the regular session, amid a whole flurry of analyst downgrades.
Yeah, I mean, that initial reaction, it reflects a market that operates on split-second algorithms, right? They're programmed to just sell on GAAP headline misses.
Right.
But when you're dealing with a financial guarantor like Assured, trading purely on the headline GAAP net income is, well, it's often a huge mistake.
And that is exactly the disconnect we are decoding today. We've got a massive stack of sources on the desk for this deep dive. We're looking at the Q2 2026 earnings release, the 10Q summary, 8K filings, the earnings call transcripts, and a very divided stack of analyst research notes.
Very divided.
So if you are holding a Kingo in your portfolio right now, you are looking at a headline earnings miss that tanked the stock nearly 9%.
Right.
But alongside that, you have an earnings call where management basically spent an hour touting underlying record valuation metrics.
Yeah, it's a stark contrast.
It feels like looking at a house with a pristine, absolutely unbreakable concrete foundation, but it has this terrible peeling coat of paint that is just temporarily scaring all the buyers away.
That's a great way to put it.
So we need to scrape off that paint, right?
Yeah.
And evaluate the actual core underwriting engine of Assured Guaranty.
Yeah, to scrape off that paint, we really have to isolate the specific source of the earnings drag.
Okay.
Because the miss that caught the headline readers off guard, it was not driven by poor insurance underwriting. I mean, the core business of collecting premiums to insure bonds didn't just fall off a cliff.
Right.
If you dig into the 10Q, it shows the miss was heavily impacted by a $10 million loss in equity earnings of investees, combined with lower foreign exchange gains compared to last year.
Okay, I want to pause on that $10 million loss in equity earnings.
Yeah.
Because this is where the accounting rules fundamentally obscure the cash-generative reality of this business.
Absolutely.
So explain how this alternative investment markdown actually works on the balance sheet.
What's fascinating here is how financial guarantors' GAAP earnings are notoriously volatile because of these mark-to-market accounting rules.
Right.
So Assured Guaranty has strategic stakes in alternative asset managers. Most notably, they have a roughly 30% ownership of Sound Point Capital Management. And because they own such a huge percentage, accounting standards actually mandate that they use the equity method.
Meaning what, exactly?
Meaning Assured has to mark those investments to market every single quarter. If the broader credit markets fluctuate, or if SoundPoint marks down the paper value of its own assets.
Assured has to pass that paper loss right through its own income statement.
Exactly.
Yeah.
Even if no actual cash left Assured's bank account.
Wait, really? No cash actually moves?
That is the critical distinction. It is completely non-operating noise. The company didn't write a $10 million check to cover a bad insurance claim.
Wow.
Yeah, they simply adjusted the carrying value of an investment on a spreadsheet. And this mark-to-market volatility completely masks the underlying cash generation of their core franchise.
Right.
When you strip out that accounting noise and look at the actual value of the business they've locked in, I mean, the picture flips entirely.
Which brings us to the metrics management was emphasizing on the call.
Yeah.
Shareholders' equity reached $126.18 per share.
Record high.
Adjusted operating shareholders' equity hit $129.94. And most importantly, adjusted book value, or ABV, climbed to a staggering $189.72 per share.
Yeah, that ABV number is wild.
Let's define the mechanism of ABV for a second, because this isn't just your standard book value metric, right?
No, not at all. Adjusted book value is basically the holy grail metric for analyzing a financial guarantor.
Okay.
Because if Assured insures a major infrastructure project today, they might collect installment premiums on that policy for, I don't know, the next 20 or 30 years.
Right, it's a long-term deal.
Exactly. But under GAAP accounting, they can't recognize all that future revenue today. It trickles in over decades.
Got it.
Adjusted book value, however, calculates the present value of all those future installment premiums they have already contracted, and it adds them back into the equity calculation.
So it's a truer picture of the locked-in value.
Exactly. It represents the true intrinsic value of the business already on the books.
Okay, let's unpack this then. Because if ABV is almost $190 a share, and the stock is trading around $75 right now, that is a massive duck count to book.
Huge.
So is the market right to punish the stock because of this alternative investment volatility? Or are retail investors missing a glaring value play here?
Well, the market might just be fundamentally mispricing the time horizon.
How so?
Institutional algorithms, they sell on that quarter-to-quarter earnings volatility introduced by the alternative investments.
Sure.
But those investments don't impact the core claims-paying resources of the actual insurance business. Management uses those alternative investments to generate higher long-term yields on their excess capital.
Right.
So the market is penalizing them for the short-term accounting mechanics while entirely ignoring the long-term compounding value represented by that $190 adjusted book value.
Okay, well, since the core valuation metrics are growing, we need to look under the hood to see where that growth is actually originating.
Yeah, we have to look at segment production.
Let's break down those numbers. The headline production, present value of new business production, or PVP, was $79 million for Q2.
Okay.
And first half PVP hit $152 million, which is up nearly 50% year over year. Plus, gross written premiums, or GWP, were $81 million.
Right. And PVP is the essential forward-looking metric here.
Explain that.
It tells you the present value of the premiums they originated in this specific quarter. So a 50% jump year over year means their underlying sales engine is accelerating dramatically.
Let's break down where that acceleration is coming from. Because in U.S. public finance, their traditional bread and butter PVP was $58 million.
Solid.
Yeah. And Assured maintained its status as the absolute market leader. They represented 51% of total U.S. municipal market insured par sold in Q2.
Wow, over half.
Exactly. First half par was over $10 billion.
I mean, that is just legacy dominance, right? They are the unquestioned leader in municipal bond insurance.
Yeah.
But we have to recognize the inherent limitation of that business. Municipal issuance is highly cyclical. It depends heavily on interest rates, infrastructure bills, the fiscal health of local governments.
Right, macro stuff.
Exactly. If a guarantor relies solely on public finance, their growth ceiling is dictated entirely by the macro environment. Plus, municipal bonds are incredibly long-duration assets.
Which perfectly sets up why CEO Dominic Frederico and CFO Ben Rosenblum are aggressively diversifying the company.
They're pivoting hard.
We need to talk about structured finance because the numbers here are just staggering.
Oh, yeah.
Gross written premiums in U.S. structured finance skyrocketed 375%.
375%.
Yes, compared to the prior year. And PVP jumped 125%. The earnings call transcripts show this was driven largely by fund finance and life insurance capital management.
Great.
I sort of picture this whole strategy like a massive, slow-moving cargo ship.
Okay.
The public finance segment is this giant cargo ship. It's stable, hold a ton of value, but it takes forever to get across the ocean.
Yeah, that makes sense.
And now, management is deploying this fleet of nimble speedboats, which is the structured finance and annuity segments, to just zip around and grab extra higher-yielding cargo.
That's a perfect analogy, because in fund finance, Assured is essentially providing credit facilities and guarantees to private equity or debt funds.
Okay.
And those funds need short-term capital bridging. These structured policies might only last a few years.
Unlike a 30-year toll road bond.
Exactly. They are highly capital efficient, meaning Assured can generate strong premium yields, free up their balance sheet quickly, and dramatically increase the velocity of their money.
And that velocity is also driving their brand new segment, annuity reinsurance.
Right.
This is Assured Life Re, formed back in January 2026 through the Warwick Re acquisition. In Q2, it posted $2 million in adjusted operating income.
Not bad for a brand new unit.
Right. They are reinsuring pension risk transfers, or PRTs, with $484 million in reserves and multi-year guaranteed annuities, or MYGAs, with a $256 million account value.
Yeah, it's a huge shift.
But wait, what exactly is the mechanism of a pension risk transfer, and why does Assured even want that liability?
So pension risk transfer happens when a big corporation decides they just no longer want the headache of managing an employee pension plan.
Sure.
It sits as this massive, unpredictable liability on their balance sheet. So the corporation pays a life insurance or reinsurance company in this case, Assured Life Read, a massive lump sum of cash to just take over the obligation of paying those retirees.
Ah,
So
nice.
Assured takes that lump sum, invests it, and bets that their investment yield will outpace the money they have to pay out to the pensioners.
So it is a pure spread business.
Exactly. It's a capital-efficient strategy to capture yield.
Okay, but does this aggressive pivot into structured finance fundamentally alter the risk profile for a retail investor? I mean, what if you just wanted a boring, stable municipal bond insurer and now you own this fleet of complex speedboats?
Well, that is the central tension of the current investment thesis, right? Management argues this diversification actually lowers overall risk because they're no longer purely beholden to the municipal credit cycle.
Right, they're spreading it out.
Exactly. Structured finance and annuities, they introduce different types of counterparty and market risks, sure, but they are also heavily collateralized and shorter in duration.
Got it.
However, it undeniably makes the company vastly more complex to analyze. You are no longer just underwriting a toll road in Texas.
That shifting risk profile directly impacts margins, which basically dictates how much capital AGO can afford to return to shareholders.
Absolutely.
So that brings us to the balance sheet and the cash flows.
Yeah.
The margins actually improved dramatically.
They really did.
Loss expense dropped to just $4 million, down from $28 million a year ago.
That's a huge drop.
Net investment income grew 10% to $98 million. And operating cash flow for the first half of the year was a really healthy $230 million.
And that $230 million in operating cash flow, that's the crucial number.
Why is that the most important one?
Because that is the fuel for their capital return engine.
Yep.
You know, a company cannot fake operating cash flow.
And they are returning that capital aggressively. AGO returned $62 million to shareholders in Q2 alone.
Nice.
Yeah, that's $45 million in share repurchases and $17 million in dividends. Looking at the year-to-date repurchases, it stands at $130 million.
Wow.
They bought 1.559 million shares at an average of $83.70, plus the quarterly dividend is 38 cents a share.
Right.
Why are these specific buybacks so critical to that valuation story?
It comes down to the math of accretion.
Okay.
Remember earlier we talked about how the adjusted book value of each share is roughly $190?
Yep.
When management uses the company's cash to buy back a share on the open market for just $84, they are retiring a claim on $190 worth of assets for less than half the price.
Oh, wow.
Right? That huge difference doesn't just vanish. It gets proportionally distributed to every single remaining share.
That's amazing for shareholders.
Exactly. By aggressively shrinking the share float at this massive discount, they are artificially turbocharging the growth of the book value for whoever's left holding the stock.
But this strategy hinges entirely on the assumption that the $190 book value is secure, right?
Yes, 100%.
We have to look at the notable risks threatening that foundation, because this is what triggered the sell-off and the analyst downgrades today.
Yeah, the credit risks.
The filings specifically highlight net economic loss development attributed to a single credit, Brightline Trains Florida LLC.
Right. In the financial guarantee business, valuation is entirely about tail risk.
Tail risk.
Yeah, the catastrophic scenarios. Like we said, aggregate loss expenses dropped from $28 million to $4 million, which sounds fantastic.
Right.
But an insurance guarantor is leveraged to perfection. They insure billions of dollars of bonds with only millions of dollars of capital. So when a specific high-profile infrastructure project, like a private passenger rail line in Florida, shows severe credit deterioration, it severely spooks rating agencies and analysts.
And that single credit event created a distinct split in analyst sentiment this week.
Oh, completely split.
Yeah, Wall Street, Zen, and Weiss Ratings both downgraded the stock. They cited near-term earnings risk from troubled credits and that alternative investment volatility.
Right.
Also, if you look at retail investor anxiety on platforms like StockTwits, there is intense worry regarding legacy pre-PA litigation.
Oh, the Puerto Rico stuff.
Exactly. Investors are terrified that the ongoing prepay bankruptcy saga is just going to keep tying up capital.
Right, but contrast that pessimistic view with the institutional analysts at KBW and UBS.
But they maintain positive ratings, right?
Yeah, KBW maintained an outperform with a $101 target, and UBS maintained a buy with a $94 target.
Interesting.
Their argument is that despite the Brightline risk and the pre-K litigation, the core franchise is intact. The downgrades are hyperfixating on a specific burning tree, while the bulls are looking at a fundamentally healthy forest.
Here's where it gets really interesting to me, though. If they are generating $230 million in operating cash flow, and they're aggressively buying back their own stock at almost $84 a share, aren't management's actions screening confidence despite the bright line risk?
That is the ultimate defense, right? Insurance valuation is all about that tail risk, but management is putting the company's balance sheet exactly where their rhetoric is.
Yeah,
They are utilizing their excess liquidity to buy back shares at what they clearly calculate as a steep discount to intrinsic value.
makes sense.
The bears might argue it's hubris, but ultimately it comes down to whether you trust management's internal credit surveillance and math or the market's panic.
Which leaves us with a final forward-looking thought for you to ponder as we wrap up this deep dive.
Let's hear it.
Think about the broader macro environment's impact on a GO's future. If interest rates shift significantly, changing the cost of capital for municipalities, how will that alter the baseline demand for Assured's insurance?
That's a great question.
Furthermore, if a broader economic downturn hits and municipal defaults actually rise, will a GO's recent aggressive expansion into structured finance and annuities act as a buoyant life raft, or an anchor dragging down their pristine book value? That is the multi-billion-dollar question. To make sure you get the answers as this story unfolds, hit follow right now for our daily no-nonsense earnings coverage.